Hello, everyone. Welcome to our second webinar on financial wellness, sponsored by the NASDAQ Foundation. Today's webinar is about investing in yourself, investing in you, putting time, money, and energy into improving your current and your future life. My name is Linda Williams. I am a community outreach and training manager with Consumer Action and your host for the day. And on behalf of Consumer Action Executive Director Anna Flores and the entire staff at Consumer Action, welcome. April is National Financial Literacy Month. It's the time of the year to raise public awareness of the importance of financial literacy and maintaining smart money management habits. And I can't think of a better way to celebrate than to have a conversation about investing, how investing can be used as a tool, not only just to build wealth, y'all, but generational wealth. Today, we're going to have a chat about various topics such as savings versus investing, the eighth wonder of the world, compound interest, investment vehicles and investment risks, retirement accounts, and creating healthy financial habits. And audience, I can't think of a better person to have this conversation with than our guest speaker today, Miss Daphne Wright. Daphne is a certified financial planner professional, a certified public accountant, an LPL investment advisor representative. She has over 2 decades of experience in this space, the business, finance, accounting, and personal financial services space. Audience, only 3% of women of color share the LPL investment advisor space in the United States. And we have one of them with us today. So we are bringing the fire today, y'all. So bring out your pen and your paper. Get ready to take some notes because we have a great webinar planned for you. Now, before I get too excited, I have a few housekeeping items to take care of, and I need to update you on what's happening at Consumer Action. This is a 90-minute webinar. If you have any questions for Daphne, please put them in the chat box. At the end of Daphne's presentation, my coworker, Nelson Santiago, he's going to facilitate a question and answer segment. This is where we get to hear from you. So please keep the conversation moving with all of those great questions, okay? The webinar is being recorded and it will live in perpetuity on our YouTube channel. You will receive a link to the recording and all handouts by tomorrow afternoon, if not sooner. AFC professionals, are you listening? You will receive the password to claim your 1.5 CEUs tomorrow as well. Now, at the end of today's webinar, you will receive a survey regarding today's session. Please complete the survey and return it to us as soon as possible. In addition, as a bonus for attending today, you will receive a certificate of completion. How about that? Now, let me take a moment to thank our sponsor. Consumer Action present this webinar with funding from the NASDAQ Foundation. A special thanks and a shout out to the foundation for supporting Consumer Action and for believing in our mission. Thank you so much. Now, let me update you on what's happening at Consumer Action. First, for those of you who are new to Consumer Action and wondering what we do, we are an educational and advocacy organization. What do we do? As displayed there on the screen. Through education and advocacy, we fight for strong consumer rights and policies that promote fairness for all consumers, but especially for underrepresented consumers nationwide. While you're on our homepage, you see that little burgundy link in the middle? Click on the little burgundy button and you will land on our COVID-19 educational project page. There you will find a ton of relevant, easy to use resources and tools for the communities that you serve. Now, let me tell you a little bit about our latest project, thanks to NASDAQ. We have created easy to read, multilingual guides for consumers on investing. That's right. You can go to our website and you can download free guides on investing that will provide you information on why, when, and how much to invest, types of investment, how to manage investment risk and costs, reducing taxes, and avoiding scams. And please, by all means, read the section on scams and frauds and make sure you share that with your clients. Also, you will find resources for learning more. And did I tell you that the guides are free? Now, since women have additional challenges to overcome when planning for the future and getting started investing, we have created a multilingual guide for women. Women, take control of your financial future. In the guide, we will identify some of the barriers women face. It will also explain why women must invest. They must start investing now. And the guide offers tips and resources to help women get started investing. Investing is critical to achieving long-term financial security and building generational wealth. But for a number of reasons, women and communities of color, they invest at a lower rate. Our multilingual guides for communities of color explain the barriers to investing for these communities and why it is crucial for these communities to start investing. Start investing now. It also provides them with tips on how they can get started and stay on track. We need to get this information into the hands of consumers. So when you're on our website, from our homepage, you can click on select training module under the quick menu. Then select investing from the drop down menu, and voila, you can print copies of the guide and share them with your clients, your family, and your friends. Or you could just send them the link and let them download the materials. I have downloaded, saved, and emailed materials to my adult children and my high school age grandkids. Why? Because it's not too early to start learning about investing. So let me go over the roadmap so you'll know where we're headed today. We open every training, virtual or in person, with the game. How much do you know? Today we have 3 true or false questions. All of the questions are taken from the multilingual guides that I described. And in addition to that, for the first time, the questions and answers will be made available as part of the handouts that you will receive tomorrow afternoon. After the game, I will introduce you to our guest speaker, read her bio, give you some information about her. The question and answer segment led by Nelson Santiago will follow. I will come back, tell you how you can donate to consumer action, and wrap up. So this is how the game is played. There are 3 true or false questions. First, I will read the question. Then I will use the chat box to answer each question. Then after I close the poll and take a look at the results, I will tell you if the statement is true or false and why. And the person with the most correct answers, drum roll please, he or she will receive the bragging rights to how much do you know. So before we roll out the very first question, I need to give you a little background information. Question 1 is about cryptocurrency. And here's the background information. 60% of those who invest in cryptocurrency say they do so because of the potential for long-term growth, while 44% of cryptocurrency investors say they do so because of the potential for high growth in a short period of time. 33% do so because of the ease of making their trade, and 26% say they do so because they love the excitement of investing. So who are these investors? Are you ready? Let's roll out the first question. Okay, true or false? More men than women invest in cryptocurrency. Is that true or is that false? More men than women invest in cryptocurrency? Don't overthink it. Okay, that's it. Let's close the poll and take a look at the results. Okay, so 90% of you believe that is a true statement. 10% said the statement is totally false. Well, it's true. According to a 2021 survey conducted by CNBC, it reveals that more men, 16%, than women, 7%, invest in cryptocurrency. And this is true for all racial and ethnic groups across the board. Across the board, 16% of men versus 7% of women invest in cryptocurrency. But here's something that's a little more interesting. More younger and middle-aged investors invest in cryptocurrency. 15% of investors are from 18 to 34, and 11% of investors are from 36 to 64, while older folks like myself, only 4% of investors over the age of 65 will invest in cryptocurrency, and that's because they're trying to retire. Okay, you can access the link to the survey on page 1 of Consumer Action's Guide to Investing for Communities of Color, Building Generational Wealth. Okay, now before we roll out the second question, let me give you a little bit of information about it. Question 2 deals with the financial impact of a divorce. Divorce can affect spouse's financial health and security in a number of different ways. So let's roll out the next question. So, true or false? The financial impact of a divorce is typically less severe for men than women. Is that true or is that false? The financial impact of a divorce is typically less severe for men than women. Don't overthink it. Okay, you keep changing your answers. Let's look at the results. 69% think this is true. 31% says the statement is false. Well, I think the answer is going to surprise everyone. It is true. According to various studies, the financial impact of a divorce is less severe for men than women. For an example, one U.S. Government Accountability Office found that men's household income fell by 23% after divorcing past the age of 50, while women's household fell by 41%. And according to another study that was conducted by the Institute for Social and Economic Research, men actually become richer after getting divorced. The incomes of separating husbands rise immediately and continuously in the year following a marital split, while women are often far worse off and can struggle. You can find the link to this study on page 2 of Consumer Actions Guide for Investing for Women. Women take control of your life. And don't send me bad emails about that question. I didn't make it up. I'm just reading the answer. Okay. You're doing great. You're doing great. Let's move on to question number 3, our last question. Question number 3 is about the investment gender gap. And when you're thinking about this question, note that while the average interest rate on savings accounts is only 0.35%, the stock market has historically had an average annual return of around 10%. So let's roll out the last question and take a look. Okay, women question, is this true or false? Women tend to feel less confident about investing than men do. In a study, only 33% of women said they felt confident in their ability to make investment decisions. Is that true or is that false? Women tend to feel less confident about investing than men do. In a study, only 33% of women said they felt confident in their ability to make investment decisions. Is that true or false? Wow. Okay, let's close the poll and take a look at the results. 95%, you say that's true. 5% is a false statement. 95%, you are absolutely right. There are 7 reasons women do not invest as widely as men. One of these is that society has conditioned women to believe that they are not good with money. As a result, fewer feel confident about investing. Another reason is that women earn less than men and may be under the misapprehension that they need large amounts of cash to start investing. You can get the link to this study on page 1 of Consumer Actions Guide on Investing for Women, Take Control of Your Financial Future. And as I said earlier, for the first time, these questions and answers will be available in the handouts that you will receive later today or at the latest by tomorrow. Now, let me introduce you to our fantastic guest speaker and tell you a little bit about her. Daphne combines over 2 decades of experience in the area of business finance, accounting, and personal financial services. As a certified financial planner professional, certified public accountant, and LPL investment advisor representative, she integrates the expansive breadth of her experience in helping individuals address a broad range of financial concerns. Daphne provides independent financial planning and investment services through her brokerage affiliation with LPL Financial. She is primarily focused on providing guidance to individuals and households, assessing planning alternatives for specific personal and financial goals, and implementing implementing coordinated financial strategies, services, or products that help with meeting economic objectives. Her academic preparation began at the University of Maryland, where she earned a Bachelor of Science degree in finance. She completed a 2-year postgraduate personal finance planning program through the College for Financial Planning in Denver, Colorado, and thereafter earned a master's in financial planning from the Institute of Business and Finance. Daphne has been investment registered for over 20 years and is licensed to practice as a CPA in Maryland and Virginia. Daphne, thank you for joining us. It is an honor to have you with us today. Now, I know you have an entire presentation planned for our audience, but before you get into that presentation, I have kind of a two-part question about kids and financial literacy and investing. We all know that one of the best ways to build wealth over time is to invest and to start at a young age. And if you start at a young age, your chances of success down the road are great. But I read a 2020 survey by CNBC and Acorn, and it stated only 39% of children in the United States have a savings account, and only 6% of children have an investment account where they are holding stocks, mutual funds, or ETF. So my question is, what can parents, guardians, aunts and uncles, everyone listening to your presentation today, what can they take away they can use to get kids excited about saving and investing? And how can they get them excited about increasing their financial literacy knowledge? We are talking about building generational wealth, having wealth to go on to our kids and our grandkids. But if we don't teach these kids about the value of money, then what's going to happen to all of this generational wealth I'm working so hard to build? Are they going to lose it?
Wow, that's a good, first of all, thank you for having me, Lyndon. That is an excellent question. I think one of the things we're going to, in the presentation, we're going to look at is the value of starting early. And so even understanding that from the adult's perspective can kind of initiate a interest and enthusiasm to make sure their young people know. But really what it is getting the child involved. A lot of times a person may say, I started this bank account or I started this investment, and they're thinking of the future welfare of the child, so they have money for, say, college. But maybe more importantly or equally important is to have the child involved in their own account. So you start a bank account so that the child can understand how money works. So you're looking at this every week or every month or every, not every week, but every month or every quarter. And you may start an account that has compound interest, savings account. You're not going to do a checking account. So letting the child see, oh, this got bigger, this got bigger, this got bigger. And so doing the same thing with a small amount of for an investment account. And they will learn through the experience. They're experiencing it in their own account. Their name is on that statement, and they say, oh, I'm making money now. And then you can also see later that, oh, that went down. So now you know how money works, you know how investment works. So, when they go for their first job, there's a familiarity of how things work. They're not afraid to invest. They're not afraid to get into their 401k, 401, enroll in the 401k and invest in stocks and bonds. And I'm just going to say this, I may be dating myself because you can't necessarily do this. When my daughter was, say, I guess she was about 3 years old, and you used to actually go to the bank. I literally had her put, have $3 and put, I had to pick her up. She put the money to the teller, and the teller gave her deposit slip back, right? And then, I would then later let my daughter see her bank statement. So the fact is, they can see it. You're not just doing it for them. They're involved. You're looking at what are the results of starting early. So I think that would be a way that we get our children the experience of seeing how money works.
Thank you, Daphne.
So on that, so we're going to really be getting into this whole presentation on investing in yourself, right? And so for our first of all, I just want to a disclaimer: everything that we're going to be speaking about today is for informational purposes. So we're not doing any, I'm not giving any specific advice, because that's something you want to always personalize for yourself. So we're really going to go into the basics of investments and actually look at those kinds of concepts that are the going to be the common types of investments that the average investor uses to build a portfolio. I may touch on some of the less common ones, but really want to focus on helping people to understand just the most basic, that most people, if you're using these, you can build a solid foundation for your investment portfolio and for building wealth. So both, what is the difference? The first thing we know, what's the difference between savings and investing? Now, both strategies involve accumulating money for the future, but their level of risk is not going to be equal. And how you determine when to save and when to invest will depend on your budget and your financial goals. So when you're saving, you're putting aside money. You're not literally looking for a whole lot of growth. You are really preserving principal. You're preserving the money you have. Now, when you're investing, it's going to involve some kind of risk. There's going to be a greater earning potential. So that's really how you're going to determine, what do I budget for saving, and then what do I budget for long-term investing. So when you're investing, your intention is to see earnings and growth of your money. The growth comes through compounding. That's what I call the eighth wonder of the world. So compounding is when you have earnings on your earnings. So to simplify your understanding, we're going to see how compounding works using the example of depositing $2,000 annually into some kind of vehicle that's going to earn 3% annually. And we're going to call this quarterly compounding. So each quarter, 1/4 of that 3% is going to be credited to the account. So when we start off, you're going to have to how compounding works. And this is the same thing that you really want to see, Linda, with that wonderful example when I say this is what your child is going to see when they see their statement, okay? So, we have the 2,000, 3%, 1/4 of that is 25%. And so it's just looking at the interest earned is $15. Now, the next quarter of the year, you can see that the interest earned is more than the 15. And so each quarter, you're earning more because you're earning on not just on the $2,000, that would be called simple interest, you're earning on your earning. So this is how compounding works, right? So in the end, you can see that $2,000 that you put in is now up to $2,123.18. So I think that was a really good illustration, a good question that you led in on, Linda, when your child sees, oh wow, I only put 2,000. This is what happens. Not only when I put money away, but here's the key. You put money in and leave it alone, right? So sometimes we haven't experienced the eighth wonder of the world that I kind of mentioned of compounding. It's not because money doesn't work. It's because we didn't put money away and left it alone. So that's when you see how money really works. So here's a good example when you're actually investing. So I call this, you see the power of long-term investing, but I also call this slide the cost of procrastination. So this illustrates an example of the concept of compounding with 3 different individuals starting to invest at age 25, 35, and 45. So you can see illustrated on the chart the difference between the account balances if each invested $1,000 a year, earning, in this example, 8.5% annually. So notice the person who started investing at age 25, they really only put in $40,000. And how do we get that? They started at age 25, they invest $1,000 each year till they're age 65, right? That's 40 years. 40, so that's 40 years times $1,000 a year. That means you only put in 40,000. But look at the account balance, okay? So this is how money works when it's left alone, okay? So generally, when you're looking at things like your investments, particularly your retirement plans where you've been investing for a long time, it is not the amount that you, the amount out of your pocket that you put in, or in this example, $40,000, that you're looking for growth. You're looking that the accumulated value has more in earnings, well more than earnings than the amount that you put in. Now, that those accumulated earnings are going to be less if you start later. So the person starting at age 35, they only put in a total of 30,000. And you can see it, how much a difference those 10 years makes. So that's why I call this the cost of procrastination, right? It really makes a difference. And at age 45, this person is only putting in 20,000. They didn't have those years of compounding for money to work for them. So, you know, it's very hard to catch up. So you really want to start young, start early, with yourself and with your children to see this. You can just put a small amount and let the money do the work for you. And I just want to just kind of just bring in perspective. You can think about, you know, this doesn't mean that you have to put $1,000 at the beginning of the year in one lump sum. If you were working, this $1,000 and you get paid every 2 weeks means you're only putting away $38 per pay period. And most people can find a way to do this. And sometimes what it takes, and I love your example, Linda. Sometimes what it takes to even find $38 is the incentive of knowing how money would work if you found that $38, right? So if you just think, oh, what's the difference? Why would I put away $38? Well, here's your why right now. But unless you know that money works this way, you may not even be incentivized to put that money away thinking it's a minimal amount. So here's just another example, I just to bring this point home. But this is a little bit different. I call this the tale of two investors. You have the early investor, Ellen, and then you have late starter, Leslie. So we're looking again at putting in this one is $2,000 a year at 8% interest compounded annually. So Ellen starts to put in money at age 21. She does it for 10 years. And then she literally just stops putting money away. On the other hand, late starter Leslie didn't focus on how she could modify her budget so she could even save $2,000 annually. And she spent her money on things she wanted. So then when she was 35 years old, when she was making more money, she figured she really needed to start putting money away for her future goals. And for the next 35 years, saved $2,000 a year in the same investment vehicle that Ellen had put her money in. Now, let's fast forward to age 65. If both wanted to use this account for their retirement, who would have more money? Leslie, who diligently saves $70,000, or Ellen, who put away a total of $20,000. So intuitively, we would almost think that all those extra years that Leslie could have caught up. But in this example, using an 8% interest, you can see that just stopping after 10 years and letting the money grow on that 20,000 gave Ellen the Advantage, where she ends up with $462,000, and late starter Leslie, who lost that 10 years of compounding, only has 372. So often I think a picture is worth 1,000 words, you know, and when you really see this makes us sometimes think, well, you know, if this is the way money works, then I should have more. So sometimes it's not that, you know, money works, right? There is a way that money works. What happens is the way we work sometimes goes against the way money works. We'll put money in, we'll take money out. We'll put money in, we'll take money out. So we're working against the way money does work if left alone. So we're going to just look at some of the common investment vehicles that you'd be investing. Oh, let me just make a point that when you're investing, well, when you're saving, you're going to be told, the institution or wherever you invest are going to say, this is what you're going to earn. You're going to earn 1.5%. You're going to earn, you know, 2.5%. You're going to earn 3% on your CDs. However, when you're invested, you're not given the rate of return. You're not giving the interest rate, rather. You are going to experience a rate of return after the fact. So it's how the market performs. So the market is going to fluctuate, and then you're going to be, and we'll look at this a little bit later, how on average, you have to look at the type of investment that may on average have performed at 8%, or on average performed at 6%. But you're not going to be finding when you're investing, someone's going to say you're going to get 6% as it is with savings vehicles. So on that note, we're going to explore some of the most common ways that the average person invests in securities to accumulate assets or grow their savings. So first, we'll just look at something everyone's kind of heard of: stocks. Stocks are also known as equity. It's a security that represents ownership of a fraction of the issuing corporation. So units of stocks are called shares. As such, stockholders are partial owners of the company. So corporations issue stocks to raise funds to operate their businesses, and the holder of the stock, which is a shareholder, may have a claim to part of the company's assets and earnings. So what we're talking about here is when a person invests in an individual stock with an individual company. We're going to talk about a little bit. This is how companies raise money by issuing stocks. Then we're going to kind of more talk about it, how the average investor is buying stocks that have been they've been issued already, but this is how stocks actually work. Okay, there are two ways to earn money by owning shares of stock, and that's through dividends or capital appreciation. So when you're buying stocks, dividends, you may earn dividends, and they're the cash distributions of the company's profits. So let's just say if a company has 1,000 shares outstanding and they declare a $5,000 dividend, then the stockholders would get $5 for each share they own. So that is going to be that is going to be an income earning on having that stock. But one of the biggest ways is that reasons people invest in stock is not necessarily for the income. It's for capital appreciation. Capital appreciation is the increase in the share price itself. So let's just say you buy a share for $10. What you want when you sell that share, you want that stock to be now maybe $20 so that it appreciated, it increased in value. So when you go to sell that stock, you would have made a profit because the stock price went up and you cashed out when the stock price went up. So there are different sizes of companies: large, medium, and small, and we're going to just we'll a little bit later kind of tell how that manifest in terms of risk. But we call that market capitalization. So that's really looking at the number of shares that are outstanding, number of shares that a company may have issued times the share price. So you have large company stocks, and these are the companies that you've heard of. These are, you know, your Home Depots, the Coca-Colas, you know, the Amazon, things like this. These are the companies with those names, those recognizable names, and the size, the amount of shares outstanding is between 10 and 200 billion. Then you have the mid cap, and so that's between the shares outstanding is 2 billion and 10 billion. Now, you may have not heard of many of these companies, but the size of the company, the size of the companies are generally smaller. Then you have small cap. Okay, so these are generally the small cap stocks are with smaller companies, and the outstanding shares is 250 million to 2 billion. Now, these companies that you know of now, many of them back in the day were, you know, Amazon was small cap at one point, and then it gets larger, right? But they start off. Now, why is this important? Because generally, when you look at companies with large cap, these are those established companies, right? And so if there's any kind of issue in the economic issue, turmoil, that kind of thing, these larger companies, a Coca-Cola is not going to go out of business or have a big effect on their financials just because there's a market turn down. They may have a lower profits, but let's just say a small company. If you have a small company stock, perhaps there's a new competitor that can come in and have a better product and kind of just wipe that company right off the face of the planet, or perhaps if we have as we've had market downturns, this company can't have access to capital, and so they can't sustain themselves, and so that company is going to be more risky to an investor than, say, the companies that are solid and have years, assets behind them and such. So kind of looking at the large company, S&P 500. So I talk about the S&P 500. This is a market index, and this is just basically, and you probably have heard this, the S&P is up, the S&P is down. And this is basically tracking the U.S. market, the 500 largest companies, 500 U.S. large company stocks. And that's kind of how we, for the most part, kind of look at how the market is performing. And there's indexes for others, but we mostly talk about the S&P 500. And I speak of this now because when you're investing, you're probably going to have as your base and foundation the large company stocks as kind of your staple investment. So this is just seeing how, again, these are rates of return. These aren't interest rates, right? This is how the S&P has performed. And if you kind of look at the 10-year average, it's something like a little bit over 10%. But if you look at, shorter periods over the last 5 years, this is going, ending in 2022, the rates of return over the last 5 years has been lower than, say, a 10% average. And this is heavily skewed by the 2022, we had a market downturn, okay? And then in the 20-year, that was skewed as well because there were events as well. The Great Recession was kind of covering that period. Then we had the 30-year returns are lower. That was during the period you may have remembered hearing about the dot-com crash. So as you can see, the investment performance of our U.S. market can fluctuate. But what you also should notice is that it's going to be much higher, it has been much higher historically, than what you can earn in a bank where you may be earning 0.5% or 1%. So this is how you have that greater growth on your investments, on your on your contributions or what are your deposits by being invested. So now let's just turn to how bonds are issued by governments and corporations when they want to also raise money. So by buying a bond, you're giving the issuer a loan. So you're handing over, the company is literally borrowing money. Okay, you're providing the loan, and that company or the government, they agree to pay you back the face value of the loan on a specific date, and to pay you also periodic interest payments along the way, usually twice a year. So a bond will have a face value. That's the amount that will be paid to the bondholder when the bond matures, say in maybe 10 years. And it's going to have a coupon rate, which is an interest rate that the issuer of the bond is paying on those periodic payments to the bondholder. So unlike stocks, bonds issued by companies give you no ownership rights. You don't necessarily benefit from the company's growth, but you won't see as much impact when the company isn't doing well either, because with the stocks, if the things are going wrong with the company, the stock price will go down, right? You may have bought it high, it'll go down. Now, if you're a bondholder, you're not affected by those stock prices, right? Or you're not affected by the companies, how the company is performing in the same way as with stocks. So you'll still get, if this company is doing well, you'll still be able to get your income, and the income is that interest based on that coupon rate. So bonds give you two potential benefits when you hold them as part of your portfolio, which we'll define a little bit later. They'll give you a stream of income, and they also offset some of the volatility you might see from owning stocks. So that's just bringing, you don't, if the market in stocks are going up and down, by having some bonds as part of your investment pool, then that can minimize some of that fluctuation. So we have different types of bonds: government issue bonds and businesses issue bonds. Government bonds are debt obligations of the government entity. They're generally risk-free when held to maturity. Since they're backed by fully by the U.S. government, the odds of default are extremely low. So relative to higher risk securities like stocks, treasury bonds have lower returns. Okay, it's not going to set the world on fire, the rate of return you're going to get on your treasury bonds, but they're going to be stable. Corporate bonds are a debt obligation of the company who issued the bond. Like all investments, bonds do carry risk. One key risk to a bondholder is that the company may fail to make those timely payments of interest and principal, right? Perhaps they're not doing well and they cannot pay the interest, or they cannot return your principal when the bond matures. If that happens, the company will default on its bonds, and the default risk makes the credit worthiness of the company. That's basically saying the company's ability to pay its obligation on time. So that's going to be something that's important to any bondholder. Can the company pay? So why do bond prices change? And we really want to mention this because many people just think, okay, wow, I'm in bonds, I'm not in stocks, I'm not putting anything at risk. Well, there are a different set of risks for bonds. It's the changes in the fundamentals of the issuer, which really means the company, something that's going on internally with the company, and then changes in interest rates. So when you think about the fundamentals of the company, there's rating organizations, Moody's and S&P. This is how you kind of look up and say, does this company's bond is what is the credit worthiness of the company who's issuing this bonds? And you have these rankings starting from the highest quality, and then to those that are lesser in quality and may have the potential to actually default. Okay, so this is that credit risk that you're wanting to know. Now, the reason that that's important is because if you're going to purchase a bond from a company that is, you're going to get your interest payments, there's no risk, that company has, a flush balance sheet and income statement, they can pay you less of interest. But if you're going to take the risk with a company that is kind of shaky, I'm not sure if they're solid enough to give me my interest on time, or 5 years from now, are they going to be there to pay this off at maturity, where they return the money that the principal, the money that I actually loaned them? Then you're going to require a higher rate of return for taking that additional risk. So you may earn more, but you're actually putting things at risk. So here's the other thing that many people who are invested in mutual funds have to understand about how bond prices change, right? So I talked about issuing bonds that are issued in the primary market. That's when you're buying a bond directly from the company. But bonds are also traded in the secondary market. That's where most of us are going to be having bonds in our portfolio from once that bond has been issued, but now the bond continues to trade, okay? It continues to trade after it has been issued originally through the company. So interest rates affect bond prices. So let's just say a bond that is a $1,000 bond, right? And the current rate of return for bonds of this nature, for this profile, is going to be 6.75%. So that coupon rate on the bond is going to be 6.75%, meaning that every 6 months for the next 10 years, perhaps next 10 years, we're going to give you interest. We're going to send you interest semi-annually of 6.75% of that 1,000, and then in 10 years you'll get your $1,000 back. But what happens if you don't hold that bond, okay? And interest rates change. Now, let's just say the current interest rate in the market. The market is always changing. Right now, anyone who is looking for a rate of return on bonds is looking for an 8% rate of return. Now, if you're going to sell that bond to someone else, are they going to buy your $1,000 bond that's only paying 6.75% when they can just go and get a brand new bond, a brand new $1,000 bond that's now currently paying 8%? So this could be like 2 years later. Now, now the market is requiring 8%. Investors are requiring 8%. Well, no, they can't sell that bond for 1,000. You're not going to buy that bond for 1,000, because you can get a new bond for 1,000 that has a coupon rate of 8%. So in order to sell your bond, you're going to have to sell it for 800, because essentially, if the investor is paying less, even though they are going to get interest payments of 6.75, that's not going to change on that bond. They are still going to when they sell that, if they hold that bond to maturity, they're going to get 1,000. So the fact that they paid only 800, they're still making effectively 8%. Inversely, if the interest rates are going down and now the bonds of this quality are earning 5.5%, you're not going to sell your bond for 1,000, because that person who purchased your bond is going to get 6.75. Now the market is now at 5.5, so you are going to sell your bond for 1,200 for a premium. It's called selling it for a premium, because this bondholder is going to get those coupon payments at 6.75% on that $1,000 bond. But when they sell it, they're going to really need to get more, because right now they could only buy bonds in the primary market that are earning 5.5%. So hopefully that is kind of clear. But what you do need to know, and you might see this in, if anyone has retirement plans and they have bond investments, you can see that your bond portfolios are going down for this particular reason. We're just going to talk really quick about cash and cash equivalents and looking at what those are. So cash equivalents are similar to cash. And so they basically are ways to kind of park money, and they can be CDs, T-bills, US government bonds. You've probably heard of those things. Money market funds also. So you're not going to earn a lot, but it's a good place to park principal. So then let's just talk about mutual funds. Now, this is going to be the benefits, offered benefits for all types of investors. So mutual funds offer professional management. When you purchase shares in a mutual fund, your money is being invested and managed by a seasoned money manager. And this makes it easy if you don't have time or don't feel comfortable picking different individual stocks. So this is what's going to be what I would say the average investor invests in mutual funds. So just like there's 100 pennies in a dollar, there are going to be, say, 100 different securities in one mutual fund. And you're going to be buying that one mutual fund, and you are getting shares. You're going to be getting shares of each of a small percent. You're purchasing a small percent of the shares in all those companies. Okay, so that is one of the easiest ways to invest. So again, it's flexible. You're going to be diversified because you're not buying one stock, or you're not buying 10 stocks. You're going to be buying a mutual fund that could have, anywhere from, 20 to most of them are going to have more than that, maybe 100 different, say, some stocks from many from stocks. It could have bonds. It could have cash equivalents. And we're going to kind of talk about, look at a couple of those variables there. But they're commonly in qualified retirement plans, your IRAs, your SEPs, very flexible. So you're going to have, you can have an array of mutual funds that you can invest in. So it's not just saying, I'm invested in stocks, I'm invested in mutual funds. No, mutual funds comes with different varieties, with different investment objectives. So I already said that stocks have another name, is equity, right? So you're going to have some mutual funds that's nothing but stocks. And we talked about the large caps, medium cap, mid cap, and small cap. So it can be large company stocks. That would be aggressive, small company stocks, I'm sorry. That would be aggressive growth. You can have growth in income. That's the stocks that the companies pay dividends, and there's capital appreciation. You can have it by sector, different categories. It could be healthcare, or transistors, things like that. Okay, and then international. There's going to be foreign, worldwide, if you want to invest outside the U.S. And then we also have different categories of mutual funds that may have government bonds. Some are corporate bonds. High yield are those ones that I talked about, where they're more risky because the companies may be closer to default or not as stable. And so those are called high yield. Sometimes it's called junk bonds. And then you can have, municipal bonds. And then you can have mutual funds that come under the category of combination. Balance means it's going to have stocks, bonds, and say money market. Okay. So basically you're going to look at what your objectives are. And then just really quickly, I'm not going to go too much into exchange traded funds, but this is also popular for many people. They're going to be a basket of investments, kind of like stocks. And they often have lower fees than mutual funds and provide diversification as well. The difference about exchange traded funds are they are sold on the stock market, and when you're purchasing those, you can purchase them throughout the day, just like when you're buying stocks and bonds, and the prices may be fluctuating. With mutual funds, you can the pricing of your mutual funds is determined at the end of the day when they the money managers balance out the whole portfolio, and that's when you know how much they call it the net asset value is for that. So that's all I'm going to really say about those. But when you're looking at your investments, you're going to look at, say, how risky are some. Okay, so you can choose investments that are very stable, just looking at keep maintaining your principal, some that are going to have accumulated growth, some that are just paying income, and then some that are more aggressive, where you're looking for greater return, but there's going to be most likely more volatility. And you're going to pair that up with your own particular risk tolerance. Okay, so if you're maybe a conservative investor, or you're a more aggressive investor, you're going to choose investments or the categories of investments that match your tolerance for risk. And tolerance for risk means, can I tolerate the risk, number one, because my objectives, if I need the money in 2 years, I'm not going to put my money at risk. I need to stay conservative. So I need to stay in something where my principal is protected, where maybe it's just money market or T-bills, where you know you're earning something, a small amount of earnings, but the volatility, the risk of loss is not there. And you can be kind of in the middle ground too. And then aggressive is usually going to be those small company stocks I talked about. It could be junk bonds as well. And then investments outside the US have a greater degree of different kinds of risk as well. Okay, you're not at the top level of being in a whole lot of risk, but it's more risky than others of greater volatility. And so you want to know the difference between asset class. An asset class is a category of funds with similar investment objectives and risk characteristics. And what this helps you to do is to reduce risk. If you diversify, you have some cash equivalents in your total pool of investments, which we call that your portfolio, some equities, some real estates, which you may invest in REITs, some bonds. So these different asset classes. And so you really want to understand the difference, or I want to distinguish for you the difference between an asset class and investment vehicles. So an asset class is, again, a category of investment types with the same similar characteristics, but you can be invested in the individual types of securities. So the security is a stock, and a bonds is a type of security. A mutual funds is what is types of securities you can invest in. So that may be sometimes a distinction of where is my money invested versus what is the kind of the risk profile in which I'm invested. Understanding that even though you can have investments that carry more risk, typically over the long term, you remember I said that mutual funds or investments in foreign countries may carry more risk, or small company or small cap and mid cap stocks may carry more risk than the large company stocks. Still, you can see through this. This is just looking at the fact. This is looking at, let me see, 1, 2, 3, 4, 5, 6, 7, 8. I think 8 different asset classes. Throughout the years, they move in different directions. So you can't just say, oh, I want to be aggressive and I'm going to invest only in small caps. Small caps, for example, in 2013 was the top performer at 38%, but in 2014, small caps on average went to 4.9. That's the light blue. Okay, and then in 2015, it's a negative 4.4, and then 2016 is back up again. Now, over time, the person in the small cap, when you average out the lows and the highs, may over a period of time earn more than the person in, say, you know, the bond category or something like that. But that volatility may be something that, you know, was not appropriate for all investors. So that is the risk, the volatility, and this is it's the risk of your investment being low or having a decrease in value at the time you need it. So that's a matter. You don't want to buy, you know, you don't want to buy high and sell, you know, sell low. So you want to buy it low, and you want it to, when you need the money, when you're ready to sell the investments, you want the price to be high, and that's how you profit. So again, model investment allocations, often people are just like, oh, I don't know which one to choose. Well, you combine them. This is the diversification. So equities represent stock, and then the brownish color represents income, bonds. So you can have a mix. So if you're a conservative investor, that doesn't mean you only put 100% of your investments in what are conserved in the conservative asset class. You just have a greater percentage of your investments in guaranteed in securities, and you still put, in this example, 20% in stocks. And you can see how, as you go up the spectrum, a moderately aggressive individual still has some conservative investments, 20%, maybe in bonds. And so that is going to also mitigate that fluctuation, so your whole portfolio. And this is just breaking it down even further into asset classes, so that even though I had those categories of stocks, there are subcategories of stock: small cap stock, large cap stock, right? And stocks in foreign countries. So you can further break down those asset classes and still be invested in different categories. Now, this is just an example of how even investing, by breaking it down into different categories, you could have split out, instead of putting 10,000 in one initial investment that earned 7, you could have split that out into 2,000 into 5 different categories, and each of those asset class categories perform differently. Even in this example, there's a loss in one, but still the average return could be much higher. If you look at the bar chart over the 25 years, you know, some did less than 7%, some did more, but overall diversification can provide a benefit. Really quickly, we're going to get into, so I can give you time for questions. When you think about investments, you want to have a realistic expectation for how your investments are performing. One way to look at this is to understanding the rule of 72. So this is just basically kind of a mathematical equation that you can figure out what would be reasonable and how my money would double. So this is basically saying you take any number divided by 72, it will tell you how long your money will double. So if you are in an investment that's earning a 3% rate of return, 72 divided by 3 equals 18. And you can see going, you know, so forth, going down this line. So you can understand when a person says, hey, I want to earn a lot. I want my money to grow, but I want to be conservative. Well, there's no such thing, right? So your conservative investments are going to be earning, say, 3% or 1%, and your more investments that are less aggressive are going to be maybe something earning 8 or 9%. But then that should give you an understanding that this is how my investment would grow, so that you're realistic. You also don't want somebody to tell you, you know, that you can earn, you know, most likely 24%. That probably is not going to happen, right? On average. Okay, so let's just look at this in terms of numbers, looking at the rule of 72. So 10,000 invested at age 30, earning 8% versus 6%, right? So using the rule of 72, this is showing how your money would double. So you do 10,000, 9 years later, it would be 20,000. 9 years after that will be 40,000. 9 years after that, 80,000, and so forth, with a total of 160. But if you had a lower earning investment vehicle where it's earning 6%, okay, it would take 12 years for the money to double. That first 10,000, it would take 12 years for it to get to 20. 12 more years, it'll go to 40. 12 more years to 80. So that kind of gives you some perspective of using the rule of 72 to anticipate the growth of your investments. Dollar cost averaging is a concept that will that can also help with investing and putting small amounts away and maybe benefiting from the price fluctuations. So this is an example of 5,000 investing. 5,000 invested. If you had 5,000 and right now you purchase something, a security that's cost $25 per share, you would be able to get $200, 200 shares. Okay, so the average cost would be $25. But let's just say you say, well, I'm going to not do it all at the same time because maybe if the price goes down, I'll get more shares. So you do, of that 5,000, you do 1,000 for the next 5 months. As you can see, the first in January was $25 per share. You got 40 shares. But on the next month, you know, even though no one really wants the stock prices to go down, but what if it did go down? How can you benefit by the fact that the stock price fell, right? Well, now that means that $1,000 buys 50 shares, right? And then you can kind of just see how the fluctuation makes a change in that last column, how many shares you purchase. So now in this example, given that the market did go down during this period from January to May, it was fluctuating. This person over that time ends up with 213 shares versus 200 shares. Okay, and then you can see that the average cost per share corresponds with having more shares, and it's 23.44. So this is called dollar cost averaging, and this is an example of putting money away every month, or putting money in with your retirement plan, or just, you know, not doing a lump sum, and many plans will allow that. So just really quickly, we'll look at retirement accounts for you know, those are 401ks are most popular. 403bs and 457s work just like them. They're just used by different entities. 403bs are used by, say, school systems and nonprofits, hospitals, things like that. 457 will be kind of your government agencies. So just looking at the difference in pre-tax income, this is just looking how this affects your taxable income and how you can accumulate more money or have more wealth to invest if your money is pre-tax. So this is looking at someone with a gross salary of $30,000. If over those, you know, in your paycheck over that year, you make contributions of $1,200. Now, if you're saving outside of a retirement plan, you're not going to get the pre-tax opportunity. You've already received that money. And so you basically, when you have that, you know, your 30,000 is not going to, you will not, the money has already been taxed. I apologize. So in this example, the whole 30,000 is going to be subject to tax versus if you do this within your retirement plan, it'll be $28,800. So federal taxes are going to be more for a tax investment outside of your retirement plan. And then the net amount that you have is going to be much less for the pre-tax plan, $24,480. And then your this is looking at if you're looking at your after-tax contributions, and the after-tax plan is $1,200, and then your net pay is $24,300 minus $24,480. So what this is basically showing is that by saving pre-tax, when you're receiving your money, there's going to be less tax withholding taken from your federal and state taxes, if that's applicable. And therefore, if there's less taxes taken out, your net take-home pay is going to be much, you're going to have much more to take home than if you are saving in some kind of investment outside of your retirement plan and a pre-tax basis. It's just looking at a different amount and just seeing as your income increases, you may be able to put more away. And the differential between your net pay and the benefit is going to be a little bit, a lot more if you're putting in a lot more. The difference between 65,700 and 67,320. Now, basically what is happening is you're not going to be paying annual taxes on your tax return, because when you have investments outside of a retirement plan, even if that money is invested, the taxes are still due. So this is kind of the net result of tax deferral. Tax deferral means you're not going to pay taxes until you take the money out. And so you just have much more because you haven't on an annual basis been paying taxes on that amount that was allowed to go into this vehicle pre-tax. So most plans now with your retirement both have a traditional 401k that's pre-tax, but they also have Roth, where it's after tax. And for many people, the Roth contributions are going to be more beneficial later on when they take the money. Roth contributions never are never taxed, or if you take them out and meet, some very minimal conditions. So when you get your money out of the traditional 401k, traditional means that it was pre-tax, you are going to pay taxes on that money when it comes out. So when it's time for retirement, every dollar that comes in is going to be taxed. Whereas money that has gone into a Roth 401k, you pay taxes on it before it went into the account. But when you take it out, every penny of that can be used tax-free. Okay, just wanted to understand with using a 401k, you can access your funds. This money is for retirement, and this is not a commercial to say take a 401k loan, but to know that sometimes you may, you may like, hey, my money is locked up for a while. So many plans are going to allow for loans. The provisions on that are going to generally be 50% of your vested account balance, or 50,000, whichever is less, and it's usually paid back with interest. So you can access your money if the plan allows. This is not something that's required; it's something that's allowed by the IRS. In the plan, the employer can design the plan that they want. For most plans, they will allow some of these things because they want people to be incentivized to participate and still know that they have a back door if they need these monies for emergencies. And I would say for emergencies. If you take money from your 401k plan before age 59 and a half, there's a 10% penalty that is paid on your tax return. There's also required that 20% federal tax withholding would 20% will be withheld before you can get that money. And so you can see that's a lot of loss on those earnings if you take money for a 401k withdrawal. One provision I'd like to just say, I think is worth noting, that you can take money out of if you have a loan on 401k and for whatever reason you've left the company, you're downsized, you laid off, if that money is still outstanding when you leave the employer, and if you can't pay it back, in one lump sum, that all becomes taxable. And remember, you've never paid 20% withholding because you got that full amount, unlike with the withdrawal. This is just a traditional Roth IRAs versus IRAs are individual retirement accounts. You can have an individual retirement account. You may not have an employer plan. So you can save on your own. The contribution limits is $6,000. If you're age 50 or over, you can put in another $1,000. You're going to have, for both traditional and Roth IRAs, tax deferred growth, meaning it's not anything that's invested will grow tax deferred until you take it out, and then it is taxed. Okay, this is different from your outside investments, in which even if you don't get that money, you get a 1099 and you pay taxes every year. So tax deferred growth means no taxes on any growth or dividends earned until it's taken out. A rollover IRA is a special type of traditional IRA. It's used when you to roll money from one employer plan. Many times you leave your employer and either you have to take money out of the plan, or you desire to move the money out of the plan. This is the only way you can get that money without incurring the tax related issues, the 20% withholding and any of the 10% penalties if you're age 59 and a half. So this is what you want to do when you leave an employer. You roll it over, and then you will not be taxed on the distribution. This is a tax-free transaction. So the traditional IRA is tax deductibility. You remember, this is your own personal account, so no one's had any pre-tax, but you can deduct it from on your tax return, the amount you put in, given you don't have an employer plan. There are limits on withdrawals, 10% penalty, 59 and a half. And then Roth IRAs, the contributions are not deductible, but tax-free withdrawals and penalty withdrawals. And then the last thing I'd like to speak about in terms of accounts that you may use, investments, are the 529 college savings plans. So it's kind of 529 plans are college saving plans. They work much like a Roth IRA. So the investments grow tax deferred. And if the money is used for qualified education expenses, you never pay taxes on that. So if someone starts this plan when their child is 2 or 3 and they wait till 18, we hope that you see that large growth that we have, the more growth, more accumulated growth than what you actually put in. All that growth would come out tax free, never pay taxes on that, if indeed it was used for education expenses. So this is a good way to save for college. And you can kind of see some of the things that you can use these qualified plans for. Even K through 12 expenses, if you're in private school, only $10,000 per year will apply for that. But for, many people use these for mostly college. So just ways to start investing. You can use online brokerage accounts. These are becoming much popular. You can invest directly with a mutual fund company, right? And then you're not kind of picking a whole lot of, the stocks, and you may just say, hey, I think I want to be in a growth fund. I want to be in an index fund. And you can contact many mutual fund companies, see what their minimum requirements. A lot of them will be low. Some will be 1,000, but some may be 5,000. But generally, many of them will allow you to do that dollar cost averaging, putting say $50 a month to start, where you don't need a lump sum. You can invest with using a financial advisor. They can help you and provide additional services and guidance with you. So that may cost a little bit more to work with a financial advisor. You can invest through your retirement plan. Remember, I said most of your retirement plans are going to have mutual funds, right? You're going to have about maybe 10 to 12 funds that you choose. And then just take some action to move forward and doing it. Start as early as possible. That's the big one right there. And just understand that you can do the diversification in many ways, but just get started and use tax deferral if you can. And so that's it. I'm available for any questions that you may have.
Thank you, Daphne. Nelson, do we have any questions for Daphne?
Yes, we definitely do. Can you hear me okay?
I definitely can.
Go ahead.
Excellent. And thank you, Daphne. That was a great presentation. We do have a few questions. Somebody's asking just sort of some basics here. Can you contribute to a Roth and traditional IRA up until April 15th of the current year to account for the previous year?
If you've not filed, up until the date that you filed your taxes. So if your taxes are not filed yet, April 15th, if your taxes aren't filed, yes. It doesn't include extensions, but yes, they can, Roth IRAs are always can go up to 15th up until the date you have filed your tax. If you filed your tax in February, you don't have to April 15th.
Great. You talked a lot about saving today. Somebody asks, how can someone who only receives a disability check once a month save? If they've got, and they have 2 kids as a dependent, any savings tips or strategies for someone in
So
that situation?
yeah, I mean, you can you only can save what your budget allows. But often what I see when people are kind of are looking to do that, they're looking at their expenses the way they have always paid for your expenses. So I really try to help people to look and see where you can cut costs. And that doesn't mean that you're frivolous. It just means that you may have a blind spot that what's normal for you, how you shop or grocery shop or the things you do, there's a different way to change cost, to get cost cutting. The other thing is not just cost cutting, and we don't have a lot of time to talk about it, but really one of the issues a person may often have to do is really to sit down, and this sometimes takes a week or a month, and look at their values, their goals, and their priorities, right? And often some of the things we spend money on are just normal to us, but when you really drill down to say what is really important, you find that you're spending money on you find that you're not spending money on what is important, some things that are important, and then you find that some of the things that you are spending money on is not that important. And I'll just say this because I'm really a behaviorist too. Often what it is that our money, and I understand the question about the disability, so that could be limitations on income, but this is often a situation. Sometimes we're frustrated with our finances because our finances are not helping us to have what we really want. But it's also because we may not have thought about what we really want. And then you kind of do this exercise and you're like, oh, if I'm using my money for what's important and I'm getting what I really value, what I really prioritize, and what I really have made a goal for, I don't feel so deprived about what my money can't do. I hope that makes sense, but that's often a way that people make a real shift and find that their money is stretching to achieve what they want to achieve. But in terms of the limited income, again, you can still kind of look, and often that sometimes works, and you find, hey, we don't need this. We don't need this extra K. We don't need this. And you may find that it stretches when you're doing some of the things that you can't do. And saving may be one of the priorities for where your why for saving is drives figuring that out. But yeah.
Thank you for all those tips. Someone's asking, how can you protect the retirement investment if you don't make it to 65? Can that money be used by children, grandchildren, etc.?
So retirement plans require that you designate a beneficiary. So any IRA, any SEP, any 401k, when you do the paperwork, it requires that you have a beneficiary. If you didn't name it, that, it's going to go to the estate. So you want to have made sure that you designated the beneficiaries that you need to designate to. Yes.
Great, excellent. And then speaking of the IRAs, somebody pointed out that for 2023, it's gone up, right, from the 6,000 now to 6,500 as the contribution.
Oh, yeah. Yes, indeed. Yes, indeed. Thank you for that correction.
Thanks. Somebody is asking, we have a couple questions about 529 plans. First is, are they are 529 investments pre or post tax?
They're post-tax because they are your money and you've already been taxed on your money. There are no tax, they're tax deferred. Once it's in the account, it'll grow tax-free, but yeah, it is post-tax because you're not going through your employer to, yes, so it's post-tax. And then the other thing it was on the slide, but I didn't mention, if the 529 plan was, you purchased one that was sponsored by your state, because every state has 529 plans. but you're not limited to buying one in your state, and the expenses when they come out are not tied to that state. But if you buy one in your state, and the state has a tax, you have state income tax, then you generally have some benefits on your state income tax for that state.
Great,
But not
thank
federal,
you.
no federal benefit.
Okay, great. And then the other on 529, is there a new law that money in a 529 can be withdrawn in the child's name if it's not used for college and put into a Roth IRA for the child? And is it 15 years after the account was started? Do you have any information on that?
Well, a child, so Roth IRAs can only be, you can only have a Roth IRA if you have earned income. So a child couldn't have a Roth IRA. And so the other part of that question was
Well, it has to do, so if the child does not go to college, then where can you put the money, or what happens?
Okay, so
And he was asking
again,
if you were,
again, the account belongs to the parent, right? And so the money, if not used for college, or if not used for qualified education expenses, that the earnings were taxable. You can take the money, it's just that the earnings are going to be taxable. So the benefit is to use that for qualified education expenses, and then you don't pay tax on the earnings.
excellent. And was there anything about after the 15-year mark, after you've opened it, some certain other things you can do with the 529 that was related to whether it wasn't used for college and how long it had been open, anything like that?
No, not there's no rules. I'm familiar with that. What you can do if your child does not use it for college, you can put it in the name of you can transfer it to the name of another relative for them to use it. But again, that money's yours. You can have it. You're just not going to get the benefit of the tax-free growth.
And if you are, say you're trying to save and you're trying to put aside the 6,500 in a Roth or a traditional IRA, should you also be opening a 529 at the same plan, or is there, what sort of the rule of thumb? Should you first save everything you can in the Roth, and then if there's anything left, go to the 529, or what's the common advice for the rule of thumb there?
Okay, so there is again a rule. I don't kind of ascribe to a rule of thumb. What I would say about that is everybody's situation. Everyone has to look at their goals and objectives, right? So whether you're putting money in a Roth or an IRA, you may have a 401k. So that's why everyone's situation is different. So if you may be putting money in a 401k, don't even need a Roth, right? And if your kids are going to have to go to college, you're going to also you may want to make sure you put some away. So you really are going to be looking at your budget, your goals, your objectives. I don't think that's an either or question. Now, if you are not prepared for retirement, and you feel like you're gonna have a shortfall, I would always say that the parent has to take care of their retirement first before they address the 529 plan, because the child may have some options to go to school in a different way, or loan, student financial aid. But we don't have options to retire. At some point we have to retire. So if there's an either or situation is when I would say that you make the option to put on your mask before you that's the analogy for the plane. Put on your mask before you put on the child's mask.
Great, thank you for the explanation. And then someone asked here a straightforward question. Government bonds, is it true that they cannot default?
It's pretty there have been in history some state bonds that may have default, but that doesn't happen much. But for the most part, they're risk-free because the government prints money. so yeah, it's not likely that the government bonds are going to default,
Excellent. Thank you for
particularly the
that.
federal government.
Thank you. Somebody's asking, my understanding, they say, is that cryptocurrency is extremely volatile and not a good investment choice. Are you able to elaborate on that or share anything on that?
No, I can't really elaborate on that. That's not my area. So, again, this presentation is really to deal with the foundational areas of investment. Some people have definitely done okay with that, but I don't have anything to add to that. I would just say that cryptocurrency is not regulated, and all the investments we've talked about are regulated. And so there is some risk in the fact that, things can happen because of that. So that's kind of all I can speak about on cryptocurrency. Do your homework.
Thank you, Daphne. Another question is, would you recommend maxing out what you can contribute to an employee matching if there is such a matching option?
Yeah, that's a good question. If it is in your budget, you definitely would, if your employer is going to match what you're contributing, you don't want to leave money on the table. And so, yes, you try to get every bit of that match. And so, yes, you put as much as you can to get that match if it's in your budget to do so. Highly recommend that. Good question.
Great.
I also say, often people say I'm not going to put money in it because my employer is not matching. That's not a good way to think of things either. We're really investing for ourselves. This was called invest in yourself. So you don't not invest because your employer is not matching, because this money is for you. Now, if your employer is matching, that's a great bonus, but you don't want that to be the incentive for you to save for your own retirement and future security and well-being.
Great, thank you. And then a couple of folks have asked, what are the best ways to find, say, a financial advisor, especially if maybe you're starting out small, you don't have that much to invest? Are there some ways to find low-cost help?
So for when you ask about a financial advisor, I guess they're saying if they are looking for a individual. There are, I'm kind of prone to being CFP, where you can kind of check a person's, credentials. You can look on, I'm just trying to think of low cost. You can get some low cost help on some of the kind of robo advisors that's investment help. But if you're looking at all around and looking at your how you incorporate your decisions with your life, I'm really going to say you can go into cfp.net and find an advisor, and every advisor charges differently, and so you'll just have to kind of interview that person for how they work. Some will be only some will provide only investments advice, some do financial planning. And so you really want to kind of ask that person. There's a lot of good information on many of the sites. You wander a mutual fund company, and there's a lot of good information if you're just starting out to kind of understand what kind of investment to get into, like do you get in an index fund, balance fund, so that kind of thing. But I don't know, I can't literally say how to look at the lowest cost, but not all investment advisors are going to, charge any kind of fee. So I think that would be a good way to look for that.
Great. And then a couple of people pointed out, I think this may be something called Secure 2.0, and this is for 2024, so maybe something to think about. Where they're, again, the 529, they're saying beneficiaries of 529 accounts have the option to roll over up to 35,000 over the course of their lifetime to their Roth IRA. Rollovers are subject to Roth IRA contribution limits.
Oh, yeah.
And then that's where the 15-year comes in. They're sharing.
Oh,
So I guess the
yeah.
idea is to help reduce the risk of overinvesting in the 529 plan.
Yeah, I guess. And I have to be honest with you. So I kind of got caught off guard on that. I remember that I didn't, I have not looked too much into that. So I apologize. And I want to applaud those who are on top of that as well. So I just have to be honest. I can't speak on, but that would be the reason. So many times people are not using their 529 plans because you get other alternatives to get to school. So that would allow that money to never become taxable. But pardon me for not being as well versed on that. And you do also understand that those 529 plans can, you want to know from your state what are, in many cases, the 529 may borrow from financial aid. So those are some of the questions you want to ask, because then then it may not be the best alternative if indeed you could do better by getting financial aid. So those are the kind of things you may want to try to research.
Great. And then I'll just give you one last question since we are going over time here. You talked about the actively managed funds. Did you have anything to share on passively managed, straight index funds, or is there a difference to what? Any thoughts on that?
So yeah, index, that's kind of what I was kind of alluding to when I was indicating that a person who may not be able to afford a particular financial advisor, you can invest easily. So the index funds, which I use the example of the S&P 500 that tracks the US large company stocks, but there are indexes for bonds, there's indexes for world stocks, foreign stocks, things like that. And so in that case, if you're invested in an index fund, you are diversified because you are, by nature being a mutual fund, you're going to be invested in many securities. You're kind of, and then also you can be in more than one index. And so you're kind of putting together your own portfolio without feeling like I have to figure out what the market is doing. So you're tied to the market. So that is a good place that's a good place to invest if you feel uncomfortable with saying, oh, which growth stock should I be in? There's all these growth stocks, which one? So it's not going to beat the market, it is used to track the market. So that, I think that was a good question. There's also asset allocation funds as well. So you can invest in one asset allocation fund, and they have already pre-selected the percentage of, say, growth stocks, growth in income stocks, bonds, and cash equivalents. So that could be one mutual fund, and you've got a piece of every asset class. The other thing it would be a good way to diversify is within your retirement plans, you often have target date funds. So it looks at the date you plan to retire, and it modifies the percentage of the asset allocation based on being more conservative or aggressive based on where you are. And so that is an alternative to picking, say, maybe 5 different asset classes or 5 different mutual funds. You're invested in one mutual fund that has already done the asset allocation.
That's fantastic. Thank you for explaining that, and thank you for going a little bit overtime with us. And we still have many people online, so thank you. And I'll turn it back over to Linda.
Thank you, Nelson, and thank you, Daphne, for that great presentation and hanging in there and answering all of those questions. Again, I want to thank our sponsor, a special thank the NASDAQ. We're offering a series of free trainings on financial wellness so that we can narrow the financial literacy and company gap for women and communities of color, and NASDAQ is supporting our effort. If you would like to contribute to Consumer Action, you can do so online by credit card or using PayPal by going to www.consumer-action.org/giving, or you can mail us a check to Consumer Action, Attention Membership Giving, 57 Post Street, Suite 111, San Francisco, California, 94104. Don't have a check? No worries. You can still support us. You can support us by subscribing to our YouTube channel. It is free and it would help us continue to bring you these great webinars. Speaking of great webinars, you can register today, right now, for our next webinar in our series on investment. It's scheduled for May 25th, and the title of the webinar is The ABCs of Investing. It's going to be a blast. If you have any questions whatsoever regarding the webinars, hit me up, send me an email. Again, a special thanks to our guest speaker for that excellent presentation. I just can't wait to hear what you think about today's webinar. So please remember to complete the survey. We value your feedback as we strive to bring you timely, relevant information that will make a difference in the lives of the consumers that you serve. Now, before I go, I want to leave you with this. Almost everyone wants to get better with their money, whether it's earning more, spending less, or building generational wealth that we've been talking about throughout the series. Financial Literacy Month is a great time to take stock of your personal finance, develop a plan to improve your finances. There's always room for improvement, right? So with 5 days left in this month, I challenge you. I challenge you to take steps over the next 5 days to improve improve your finances. Open Identify the areas where your money is going. Open up a high yield savings account. If you have debt, figure out how long it's going to take you to pay off that debt. Take a look at the interest rates on the credit cards that you're paying now and make a plan to pay off that high interest debt. Start an emergency savings. Look at your credit utilization. Can it be improved? Look for money to invest. Are you paying too much for auto or home insurance? What about those gym subscriptions? Are you paying too much? If you have spending holes in your budget, I challenge you to find those holes and shore them up. I also challenge you to pass this challenge on to someone else, a coworker, a client. Make it a family project. Talk to your kids and your grandkids about money. Remember, if we don't teach this next generation how to deal with money, all of that generational wealth you are building, they may lose it all. Thank you for joining us and submitting your questions. A link to the recording will be released soon, so watch your inbox. Hope to see you on May 25th. Thank you for what you do. Thank you for your service, and have a great rest of your day.